if you own Bitcoin and you didn't sell last year, sell now.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
Look at the ARK Innovation ETF. That was up 29%. Remember, that was beaten down the most, and so it had an even bigger rebound as investors are again making the wrong assumption that this easing cycle is going to be a carbon copy of the last one. And so they want to buy the crappiest type names, the most speculative names, like the ones that are in that fund. In fact, getting to crappy speculative names, Bitcoin, as I alluded to earlier in my April Fool's joke, was up about 70% on the quarter. And I know all the Bitcoin guys are just, excited about this and bragging about how this is the top performing asset. In fact, the Grayscale Bitcoin Trust did even better. It was up 120% on the quarter. So the discount narrowed as some more people are betting, I guess, that maybe they might be able to get this thing to be an ETF and they'll be able to cash out at NAV or at something like that. But so the Grayscale Bitcoin Trust, which was down more than Bitcoin in 2022, has rebounded more than Bitcoin in 2023. And the Bitcoin story is a little bit different because not only is it rising with the other highly speculative risk-on tech names, but a lot of people in the Bitcoin community are reacting to this Fed pivot because part of the rationale for buying Bitcoin was similar to my rationale for wanting to buy gold or wanting to buy gold stocks, which was that I knew that eventually the Fed was going to pivot because I knew that its feigned inflation fight would create a financial crisis, and that the minute that financial crisis reared its head, the Fed would be forced to pivot in its inflation fight because it would become more concerned over the impending financial crisis. And so that is where we are. And so we've now got the unofficial pivot. I mean, the reason I'm saying it's unofficial is because the Fed hasn't cut rates. And even though it's done quantitative easing, it's kind of denying that it's doing it. And it's come up with these BS excuses why what it's doing is not quantitative easing, even though it's doing exactly what it was doing when it was admitting to doing quantitative easing. But you have to read between the lines. It's not that hard to do that, right? Because, there's a lot there and the lines are pretty wide. But you have to read between them and recognize that the Fed has already pivoted. I mean, you can't wait for an engraved invitation because by the time that happens, the prices of gold and things like that are going to be much, much higher, which is why I've been encouraging people to buy. By the way, gold itself was up about $140 an ounce on the quarter. We didn't close the quarter above 2,000. We poked above it a couple of times. We closed at $1,970 an ounce. So the markets are giving you an opportunity to buy gold below 2,000. I don't know how much longer that opportunity is going to be there, but I do expect to see a big move up in the price of gold, which is why I, really have been suggesting very strongly that those of you who have been on the fence regarding their purchases, get off the fence and make your purchase. Contact Schiff Gold and do that, or talk to the reps at Euro-Pacific Asset Management about getting involved in the mining stocks through a separately managed account through my gold fund. And if you own Bitcoin and you didn't sell last year, sell now. You've got this great rally in Bitcoin. I mean, we're not quite back to 30,000, but maybe we're as close as we're going to get. We'll see. I mean, it's hard to know exactly when this thing is going to run out of steam. Maybe it's doing it now, but it's up around 28,000. There is a lot more optimism now in Bitcoin. I've noticed that. I think because that the Fed has gone back to QE, because everybody realizes that they're going to be cutting rates because we're embarking on a financial crisis. And the Bitcoin people think this is it. This is the moment we've been waiting for, right? No, it's the moment I've been waiting for. They've been waiting for it too, but they're betting on the wrong horse, because what this moment is going to do is expose the Fed. It's going to destroy the dollar, and it's going to result in more people moving into gold as an alternative to the dollar. They're not going to be moving into Bitcoin. People think they will, but they're wrong. But because other people still think that's going to happen, you've got this rally. So people who are in Bitcoin, you have an opportunity now to change horses and actually get on the winner and get off this horse. I know, yes, Tudor Jones said it was the fastest horse in the race, but I don't think it's in the race anymore. I think it's headed to the glue factory. So you got to get on the gold horse. If you want a faster horse, then try silver. I know Hi-Ho Silver, that might be it. I think that was the Long Ranger's horse, right? Silver. So I think silver could be the one you want to ride in this inflationary environment. But anyway, getting back to the numbers. So part of what was going on that was driving the moves was the dollar, which stopped going up. Remember, the dollar had been strong. The dollar was down on the quarter. It didn't collapse on the quarter, but it dropped. The dollar index ended last year at 103.5, and it ended the quarter at 102.60. So despite three rate hikes, or two rate hikes, 75 basis points. We had a 50 and a 25, right? I think. So despite those rate hikes, the dollar went down. So the dollar didn't go up with the rate hikes. It went down. And now that the Fed is done hiking, well, now the dollar can really go down. But the big move was in the bond market. This was what really helps explain the enthusiasm for tech stocks, and that is the rise in bond prices, the drop in yields on the longer maturity debt, and the inversion of the yield curve. So the yield for the 30-year Treasury on the quarter went from 4% to 3.7%. On the 10-year, we went from 3.9 to 3.5. And the 5-year went from 4% to 3.6. So despite the fact that the Fed hiked interest rates by 75 basis points, long-term yields went down. And even though the Fed funds rate is now 5%, you're only getting 3.7% on a 30-year Treasury, 3.5 on a 10, and 3.6 on a 5. So the markets are baking in not only substantial rate cuts, and in fact, the rate cuts are going to start, according to the market, but over the summer. If you look at the yield on a one-year Treasury bill, they imply that the Fed is going to be cutting rates, I think, by the summer. So not only have they finished hiking, but they're about to start cutting. But also inherent in the assumption that the Fed can cut rates is that when the Fed cuts rates, inflation is going to keep on falling. It's not. Inflation is going to keep on rising, I think, regardless of what the Fed does with rates, because the inflation that we are dealing with right now, the Fed was creating it for 12 years. We're only now at the cusp of the problem manifesting itself. There was a much longer lag for many, many reasons that I've gone over on other podcasts, but we finally caught up with the inflation that was unleashed over a decade ago. And so as this money now continues to make its way through the economy, it is going to bid up prices. But I think what's going to be even more important is going to be the drop in the value of the US dollar. In fact, again, I think it was yesterday, more news on a deal between Brazil and China. And China is Brazil's largest trading partner, but now these two nations are going to be trading with one another and invoicing and settling their transactions in their own currencies, whereas they used to use the US dollar. So just another nail in that coffin. You can see this going on now, flashing red lights that the world is de-dollarizing. And, you know, the main reason that when the Fed went to QE the first time in 2009, 2010, the reason the dollar didn't immediately drop was because the world's central banks were loading up on dollars. They were buying all these dollars. They were buying all these treasuries. Remember, we called it the currency war because they didn't want their currencies to go up against the dollar. Well, that is completely different now. They would love to see their currencies go up against the dollar. They want out of the dollar. And so as the Fed re-embarks on this new easing cycle, more QE, which is just inflation, as they start creating inflation, instead of trying to put out the fire, they're throwing more wood on the fire, and they're no longer hiking rates. And by the way, I don't think we're going to go back down to zero. I don't think the Fed is going to be able to do that, given how high inflation is going to get in the months and years ahead. That doesn't mean they're not going to try. They're not going to cut rates somewhat. But I don't think there's going to be a situation like COVID where the Fed is allowed to bring them all the way down to zero. I don't even think they'll get down to 1%, which is where they were after the dot-com bubble. So the Fed doesn't have the ability to provide that much stimulus to the markets, which is one of the reasons that tech stocks did so well now as they did then, because you've got inflation that is an intervening factor that wasn't a factor then. But I think the enormity of the budget deficits and the ongoing financial crisis in the banking sector, which is going to spill over beyond the banks. First of all, it's not just Silicon Valley Bank or Signature Bank. It's all the banks that have these problems. But it's not just the banks that are going to be impacted by higher rates. Even if the Fed cuts rates a little bit from where they still are, they're still much higher than they were when a lot of debt was incurred. And all that debt is going to be rolled over. So it's not just the banks that are in a predicament. And again, it's not just private banks. The Federal Reserve, its balance sheet is way underwater. It's losing a lot of money. It's having to send those bills to the Treasury. But corporate America, a lot of state governments and municipalities, they took on a lot of debt. Some of that debt is shorter in term. It's going to mature, right? Everybody has been living off of cheap money. And that cheap money has enabled debtors to take on even more debt. But the problem is, as the cost of that debt rises, they can't afford to service it, let alone repay it. And that's going to happen in corporate America. That's going to happen for individuals who took on too much debt. It's 12 years that debtors have been given this huge subsidy in the form of these artificially low rates. And even though they're still low, they're not as low as they were, and that's going to create a big problem.